The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everybody. Thank you for taking this Tuesday morning of January 5th out to attend this presentation. My name is Michael Valtos from Orderflows.com, and today I'm going to be talking about finding winning trades in the order flow. My goal for you today is it's basically to show you how to leverage the information that's generated by the market so you're always trading in the same direction of the market. That's a simple concept in trading, but people are always trying to fight the way the market is going, right? Market keeps going up, people want to short it. Market keeps dropping, people want to keep buying it. I was talking to somebody last night. They said, "Oh, yesterday, if you remember in the S&Ps, we kept dropping, right? Kept falling. And the guy's like, I tried to buy, I lost. I tried to buy, I lost. I tried to buy, I lost. Why try to fight the way the market is going? Why not go in the direction of the market?" And I'm going to show you how you can use order flow to be on the right side of the market. On a day like yesterday where the market just keeps dropping, it's easy in hindsight to look back and say, yeah, it was a big down day. You should have just been short. But most days is not as dramatic as what we saw yesterday on January 4th. Now, what makes order flow different than, say, technical analysis is, order flow is not the latest, greatest fad in trading. A lot of people like to say, oh, order flow is the new fad, that everyone's trying to get involved in. Order flow has been around for, well over 100 years. If you've ever read the book Reminiscence of a Stock Operator, right, which is one of the books that many great traders have said over time is probably been the most influential in their career. The guy was a tape reader, and that takes place in the 1920s. Okay, so tape reading and order flow is the same thing, and it's what we look at now and consider order flow is what they used to call tape reading in the past. Now, this training is for serious traders that want to understand what is actually happening in the market. Again, it's not what I'll be talking about today is not for people that are just, looking to jump from shiny object to shiny object. Oh, here's a new indicator. I'm going to get it. Try it for a couple of days. Oh, I lost on 3 trades in a row. It must be wrong, and just move on to something else. Order flow is about understanding what's happening in the market. And in this training, you're going to discover an easy way to see who is in control of the market, right? Once you know who's in control of the market right now, then you understand the direction of the market. And when you understand who's in control of the market, you're going to be trading in sync with the market, right? You're going to be going with the direction of the market rather than trying to keep fighting the market. I will also talk about why the market stops and reverses. When a market reaches a certain level and then starts a reversal, that makes some of the best trades that you can have. Why? Because, imagine, we rally up to a high and then we start to reverse. We got the whole entire move of the day to potentially capture and more if it keeps continuing. And by the end of this presentation, you should come away with ways to use order flow to find winning trades. Now, my promise is if you stick around to the end, this is going to be a no BS webinar. I'm not going to try and sugarcoat things. I'm going to show you examples just from yesterday because I want you to understand, what I'm talking about happens every day in pretty much every single market. Now, some days, some markets are quieter than others, but in general, what I'll be showing you today happens every day in pretty much all markets. And if you stay until the end, I'm going to show you how to get a copy of my book, Trading Order Flow. It's 150 pages. You're not going to get the actual hard copy. You're going to get, I'll show you how to get the link to download the PDF so that you can download it to your PC or your smartphone. You can print it up if you like. Now, what makes order flow analysis such a powerful tool for traders is 3 things. Number 1, order flow gets you as close as possible to what's happening in the market, right? As a trader, you want to be, on the side of the market and what's happening right now in the market. And order flow analysis allows you to get as close to the market as possible. In the old days, right, people used to pay hundreds of thousands of dollars for a membership for an exchange, or they could lease a seat for thousands of dollars because they wanted to be there in the middle of the order flow. They wanted to see what was happening. They want to take part in it. Order flow analysis gives you that advantage now that people were paying thousands of dollars a month for in the past. The second reason, order flow allows you to gauge the tendency a market will continue in a direction, right? The new trading activity, the volume, is what keeps the market moving in a direction. We've all got into a position, right? We've all bought the market and the market immediately sells off. Why? It's because the order flow, the new activity that comes in immediately after you get into a position, right, may be contrary to what you thought the market was going to do. So imagine, you get long, but then all of a sudden the order flow is bearish. Well, you're not going to make any money. You're going to get stopped out. But if you can read what that it's changed in the order flow, that's gone from bullish, what you thought was a bullish situation to all of a sudden bearish, you could get out earlier rather than taking a full stop loss. So it's going to allow you to control your risk. Now, number three, you're going to have better, more complete information than pretty much everybody else. I say 99%, but really the amount of people that use order flow is so small that it's going to give you an advantage over everybody else. Most people are only looking at the open, high, low, close, and maybe volume, right? But most traders aren't paying attention to the order flow. Sort of sort of brings up to the next issue that traders face is not all traders are equal, right? So even though I say 99% traders only look at open, high, low, close, within that 1%, you got some very big traders, big hedge funds, big portfolio managers that are starting to look at the data provided by the order flow. So even though it's 99%, within that 1%, you have some very massive, big funds behind it that are using order flow now. So again, if you're not using order flow, you're going to be left in the dust. Now, for those of you that are not familiar with me, my name is Michael Valtos, right? And I have over 25 years professional trading experience, not just trading experience from my own account. No, I worked on the CME floor. I started on the CME floor with Dean Witter Reynolds. Okay, I spent a few years there, and eventually I left to go work on their upstairs trading desk, the off-the-floor trading desk, when electronic trading was just starting up. CME had Globex, CBOT had Project A, NYMEX had Access, NYMEX, COMEX, they called it Access, was their system to their market. So the electronic, when the markets were starting to move electronic, I realized that's where I wanted to be. After I left Dean Witter Reynolds, I joined EDF Man, the big English trading company, on their global macro futures trading desk in Chicago. And again, just trading futures. I've been trading futures my entire career. After Man, I joined Commerzbank as a licensed Eurex trader. Right? You have in Eurex, in those days, to be able to trade on Eurex, you have to have a license from the exchange, right? And it's a big test, and in the past, I don't know if they still do, some business schools in Europe required that as a prerequisite to be applied, to join their business program. You have to pass that Eurex traders test. And it's a pain in the ass test, but you have to do it. It's much more difficult than the Series 3, believe me. After Commerzbank, I left and I joined Cargill, right? The big US commodity trading company. I was the head of the futures trading desk. We traded everything you could imagine, that was tradable there, whether it's futures or cash products, we traded everything. After Cargill, I joined JP Morgan, vice president of futures trading, right? And again, all these jobs are on the trading desk trading, right? And it's trading at very high level. But after spending 8 years at JP Morgan, I just turned like 41, 42, gotten married, had our first kid, and I realized, what? I don't want to be a slave to a bank in the sense that, I love trading, but, I want to do it on my own. I left JP Morgan. I started up Orderflows, and I was just trading for myself. Okay. And, that's the beauty of being good at trading is, you're able to do it from anywhere in the world, and you could do it, you could set your own hours. If you want to work, you don't want to work. That's what trading gives you. It gives you freedom. And when I created Orderflows, I started by writing my book, right? The book that you get for free. But I realized, as I was trading, that software can do more than just, put a footprint chart, an order flow chart there for me. So in 2015, I released the Orderflows Trader software. Now it runs on NinjaTrader 8. We just did a recent upgrade to to Orderflows Trader 3.0. And it's a footprint chart, an order flow footprint chart with pre-programmed indicators in it to highlight certain things in the order flow to you. And the reason why I talk about this software is because I want you to understand that the charts that you're going to see here in this presentation are generated from that software. And if you're using, there's a lot of software out there, right? Order flow footprint charts that just put up a footprint for you, right? But unless you know what you're going to look for in the order flow, it's pretty useless, honestly, because you'll just be chasing windmills, right? You're going to be Don Quixote chasing after windmills. But when you understand what to look for, and that's why I'm doing this presentation, is to show you things that you can look for if you're just using anybody's software. Yeah, I would like if you use my software because I think it makes trading easy. But if you're using Sierra Chart, or if you're using, the Ninja Trader plain order flow that comes with the paid version, you could look for these things, okay? But I'm going to show you how to make it a lot more easy, right? And you're going to see how easily and quickly you can apply order flow analysis to your trading to make better trades. Don't take it from me, I'm biased, but what other customers have been saying is, the software, my order flows trader software, is very helpful because I can clearly see now what's really happening in the market. Okay. So before we begin, just a brief disclaimer. Risk capital is money that could be lost without jeopardizing your financial security or lifestyle. Okay. And remember, only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Yesterday, this is the E-minis. All the charts in this presentation are from yesterday. This was the big sell-off, right? It was a massive sell-off yesterday. And did you ever stop and think where the information that you look at your chart comes from? Well, it comes from the time and sales, right? And this is what most people think order flow is about. Oh, you got to stare at the time and sales, or oh, you got to stare at a dome, right? But to be honest, time and sales moves super fast, right? Even a dome moves very fast for a lot of people. And the way I describe having these, staring at these things, either the dome or time and sales, is like being in a casino, watching the slot machine, watching the wheels of a slot machine go around. You get excited. Oh, the market's moving. I got to get involved. Well, S&P's just jumped 2 points. I got to do something. I got to buy, or I got to sell. And you're going to find yourself in a lot of trades you shouldn't be in because you're getting overexcited. Again, it's like having a slot machine on your dealing desk, your trading desk. Now, the problem, though, right, with time and sales, as well as the dome, right, the depth of market, the price ladder, whatever you want to call it, it's just that it moves too fast for traders to understand what's really happening in the market, right? It just becomes a blur. It's just moving so fast. So what's the difference between time and sales and a bar chart? Well, the bar chart just shows the price that traded, right? That's all, right? That's all it does. It just shows you, oh, the market opened here. This was the high. This was the low. This is where it closed. It doesn't show you the volume. Time and sales shows the price traded and the volume traded, and more importantly, the side of the market it traded on, right? So remember, go back to yesterday, right? We had this little rally, right? Just after the cash opened, and we sold off, got this little bump up here. Some people thought, oh, this is a great buying opportunity. I got to buy it here. Then the market continued to sell off, another 50 points, right? So this is that little area there in the box magnified. Okay, and if you're just looking at this, imagine you're just looking at a bar chart. You think, oh, I got a pin bar here, that's bullish. I got some green bars. Oh, that's bullish. This market's going up. But if you're watching the order flow, what you're seeing is actually, even though the market is starting to go up a bit, it's rallied from 43 up to 48. Nice 5-point rally, a little rotation there. You're seeing bullish things in the order flow, right? You're seeing aggressive selling coming in. You're seeing market sweeps. You're seeing market weakness come in. That's what the order flow is going to tell you. So you could be, instead of thinking, I should be buying it in here, instead you should be looking to short it. So before we begin, just basic background on order flow. What exactly is order flow and why is it important? Well, most traders view the market just on a simple candlestick chart, right here on the left, right? Oh, this is where we opened up here at 39.5. We had a low of 38.75. We closed at 39.25. Simple. Now, an order flow trader views the market. Well, yeah, we opened up at 39.5. Most of the volume went through at 39.25. We did trade 38.75, very small volume. There's a little bit of buying that came in off the low. You got a buying imbalance there. That's how order flow traders view the market. It's a bit different than your normal candlestick chart. Excuse me. So most traders just view the market. Oh, we opened here. They look at, well, hey, we opened in this bar and we closed here. Next bar was a little bit higher, higher high, just like that, right? It's two-dimensional. The information that you see on the bar chart, right, on your normal bar chart, there, it comes from the time and sales, but it's leaving out the most important part of the data that's available to you, and that's the volume that's traded on the bid and the volume that's traded on the offer, right? Again, all you're looking at is just what traded on, where the market opened, where it closed, what the high and the low was. It's disregarding all the volume, and that's very important. That's very valuable information to a trader. And again, this is how an order flow trader will view the market. They'll look at what the volume was on the bid, what the volume was on the offer, the relationship in the two-way auction. They're going to be looking to see, are aggressive buyers in control or aggressive sellers in control? Is it just mostly aggressive buying or mostly aggressive selling? There's so much information that can be derived from this simple, elegant footprint chart. And again, like I was saying, 99% of traders aren't looking at it. The 1% are. They're getting, they're getting so much information out of here. So again, the bar chart just shows the price that traded, but that's just the starting point. An order flow chart shows the price traded and the volume, but more importantly, the volume traded on the bid and the volume traded on the offer. It tells you the direction of the market through aggression. Remember, markets trade in a two-way auction. There is a bid, which are buyers, and there is an offer, which are the sellers. These traders are called passive traders. But for a trade to happen, someone needs to buy the offer or a trader needs to sell the bid. When a trader does that, he is considered the aggressor, right? They're called aggressive traders. So imagine, market is 5 bid at 6. No trade's going to happen unless somebody that's bidding at 5 goes up to 6, or someone trying to sell it at 6 goes down to 5. If it's 5 bid at 6 and you're just sitting on the bid or you're just sitting on the offer, you're considered a passive trader. Now, again, traders paid a lot of money to be on the trading floor so they could trade off of this information, right? They could see where the orders are coming from. Is it a big bank? Is it, just some retail company that, some retail brokerage just got a small order? All volume matters. Now, here's the time and sales, okay? And it gives you so much information. Problem is, it moves so fast. So you can see down here at the blue, the market is currently 36.86 and a quarter bid, offered at 36.86 and a half offer. How can I tell? Do you ever wonder why some of these are green, some are red, or in this case, orange? When it's green, it's telling you someone was lifting the offer, someone was buying the offer. When it's red, or in this case, orange, it's telling you someone was selling into the bid. So if I see red, I know someone is selling into that bid, right? So I know the bid is 36.86 and a quarter. If I see green, I know someone was buying from the offer, someone was lifting the offer, right? So I know the offer is 36.86 and a half because it's trading 86 and a half and it's green. So that means someone's buying that offer. Now here, the market went right in here where this yellow arrow is. It went from 86 and a half offer to 86 and a half bid. How do I know? It's because it was green. So someone was buying the offer here. It was offered at 86 and a half. Now all of a sudden, someone is selling it at 86 and a half. That means the market has turned bid. Okay. So it's 86 and a half bid right now, 86 and a half at 86 and 3/4. If this is, a one tick spread. But what happened is all of a sudden, when someone bought a bunch of 86 and a halves, turned it bid, then a seller came in, sold the 86 halves, sold the 86 and a quarters, all the way down to 86 even, right? They turned it 86 even offer right here. Okay, now someone, in this 1 second, someone came in and bought one. There's sort of, as markets move so fast, as the person was selling it at 86 and a half, 86 and a quarter, someone bought one. But I could see here, someone, started hitting the 86s even here. Now, again, this is time and sales. This is all within 1 second, right? And there's actually more trades, but this gives you an idea. If you're looking at time and sales, you're not gonna be able to make heads or tails of it. It's all happening so fast. Again, this is all within 1 second. It goes from 86 and a quarter offer all the way up to 86 and 3/4 offer, back down to 86. So, traders realize there's a lot of information there on the time and sales, but it's just too difficult to make heads or tails out of, right? They needed an easy to read format. So, they came up with the footprint chart. I didn't invent the footprint chart. There's other traders before me that did, and, God bless them, because it's such a big help to traders nowadays. It takes all that information here that you see trading and puts it all in here so it's easy to read, right? And you can make heads and tails of it. You can make sense of it, and you can make sense of the market. So once you organize that data based on how it's traded, you have a lot of data points to analyze. And the three building blocks of order flow is delta, point of control, and imbalances. Now, delta is the difference between aggressive buying and aggressive selling. Point of control is the price level in the bar with the most volume, right? Every bar is going to have a delta. Every bar is going to have a point of control. Now, imbalances is what happens in the bar, right? It's what happens, when you have aggressive buyers outnumbering aggressive sellers by 4-1 or more, or vice versa, right? So it's telling you what's happening in the two-way auction. The delta is the final number between aggressive buyers and aggressive selling in a bar. Point of control is simply just the price level with the most volume. But imbalances, it's what's happening inside the bar. And why is this important? Is because as the market is selling off, delta is generally going to be negative, right? Because it's telling you aggressive sellers are in control in each bar. Now, of course, you'll have one or two bars in there sometimes that go opposite. But in generally, when markets rally, you're going to see nice positive delta. Normally, most order flow charts will put it along the bottom so it's easy to read. Sometimes you don't want too much stuff all over your chart. Again, point of control is the price level in a bar with the most volume. And an order flow chart will have it, highlighted there, usually in a gray rectangle. Every bar has one. I highlighted a few. I didn't highlight all of them. And why is it important? It's because, have you ever wondered why a bar retraces to a certain level? Okay, it just seems, bar opens, rallies up. You can see here, just rallies up, gets within a tick of this point of control, and then sells off, because that's where the volume was. That's where everyone was happy to trade. That's sort of, in a crude sense, the value of this bar, right? The fair price of this bar is right there. Okay, even here, right? We opened up, rallied up right to that point of control. Here we opened up higher, came within a tick or two of this point of control. Here we opened up right on the point of control, went higher. And you can look through charts, you can see how well these hold over time. Now, imbalances is a good way to determine the direction of the market, right? If you're going to see a lot of selling imbalances in a bar, that's these red numbers are selling imbalances, or blue numbers in a bar, those are buying imbalances, okay? And it's going to help tell you that the direction of the market. Okay, so imagine, right? This market sold off. It's got this little bounce. I'm going to get short here, but then all of a sudden you see a lot of buying imbalances. That's not a good sign if you're short. Just as if you got long, somewhere earlier in this bar, then underneath where you got long, you start seeing a lot of selling imbalances. That's not a good sign. Right? That's how order flow is going to help you determine, A, whether you should still be in the trade, or B, if conditions have changed in the market. Now, imbalances are caused in the two-way auction. So you can see here, right, there's 14 against 139 in this green bar right here. 14 against 139, that's almost 10-1. That's like 9.8-1. That's an imbalance. 6 against 43, that's an imbalance. Now, 19 against 56 is not a 4-1 percentage, right? A ratio of 400%. So you could actually adjust what you want to use as your imbalance threshold. But most people use 4-1, and that's a good starting point for most people. Now, think of it this way: the difference between bar chart, order flow chart is a piece of pizza, right? That's your bar chart. Yeah, that's nice. You could eat. You could live off a bar chart, okay? but it's just showing you what's traded at price. Order flow is the whole pizza. So why settle for just a slice when you could have the whole pizza, right? You get a more complete picture of what's happening in the market. Maybe you don't want that slice there. You want the slice on the other side. It's up to you. There's so much more you can do rather than just being confined to one slice. Now, having all that order flow information is nice, right? You can see how the market traded, but this is 21st century. It's not the 1980s, on a DOS screen, where you're just looking at amber colors or those funky old orange colors. Computers can do a lot for a trader now, right? For me, I like all sorts of stuff on my pizza, right? I don't want just cheese. I want olives. I want sausage. I want tomatoes. I want peppers. I want more cheese. That's why I created the Orderflows Trader software. I basically take a plain pizza and made it taste better, right? There's nothing wrong with a plain cheese pizza. Don't get me wrong. But it's plain, right? Just like most Orderflow software out there, it's plain. I took it a step further when I created the Orderflow software because I was trading with Orderflow myself, and I realized, what the hell am I doing? After I left JP Morgan, where I got so much computing power at my fingertips, and I'm trading for myself. I'm like, gosh, why are we using software that just shows you what the volume was trading on the bid and the offer, just the delta, just the point of control, just the imbalances? I want to see where buyers and sellers are getting stronger or weaker, where the market's potentially reversing, who's in control of the market, right? Orderflows Trader takes all that information you see in the time and sales and depth of market and transforms it into an easy to read, understand chart, right? This is just your normal plain footprint chart. It's already got a lot of data, which is good, for experienced traders that have been watching order flow for a long time. Yeah, you can deal with that. But if you're sort of newer to order flow, or you want to sort of turbocharge your trading, that's why I created my softwares, because I wanted to take my trading to another level, right? I didn't have the resources that I had when I was working in banks or trading firms. I could just pick up a phone, call somebody, they could, run analysis for me, do all sorts of stuff. I wanted my software, my trading software, to show me market weakness, to show me support resistance, to show me when a market was being swept, when there was imbalance, where there was value, where there was aggressive trading, and so much more. So this is the Orderflow Trader software with, some of the things highlighted. Now I can see where there's market weakness. Now I can see where there's support and resistance. Now I can see, where there's a lot of imbalances in a bar, where there's market being swept in the, when there's someone is sweeping the market right in here. And, that's what you want as a trader, right? You want to have as many tools in your toolbox as possible to make your trading easier. Now, the reason why I talk about the order flows traders is because I want you to see how easy reading the order flow can be when you have the right tools, right? And basically that's just having the right software. You're going to be able to see who's in control of the market, how to be in sync with the market, and understand why the markets stop and reverse. So if you ever stop to think what makes the market go up or down, people are going to say support and resistance. Well, not really. It's the aggressive traders. It's the traders in the market that cause the market to go up or down. And precisely, it's the aggressive traders. The passive traders don't, right? They're just happy to sit on the bid, happy to sit on the offer. They create support and resistance, but it's the aggressive traders that cause the markets to go up or down. But how can you see aggressive trading on a bar chart? You can't. It appears on the time and sales, but who wants to look at time and sales all day? You'll go blind. The easiest way is to look for imbalances in the footprints. Now, these are just a couple of little bars here, right? You can see selling imbalances are red in the bar. That's these red numbers in the bar. That's buying imbalances are the blue numbers in the bar. Okay, now when people start looking at a footprint chart, they get scared because there's so many numbers. People are scared of numbers. People hate math in general. Okay, but what I'm telling you is you don't have to analyze every single trade that goes through. You're just looking for certain things in the order flow, and one of them is imbalances. So first I'll talk about buying imbalances. Okay, now bars have buying imbalances, they have selling imbalances. Okay, alone by itself, it may not mean anything, but when you start to put them together in context of the market, then you could understand what's happening in the market. And you can see as this market is rallying, we're seeing a lot of buying imbalances. This bar's got 3, this bar's got 3, this bar's got 2, this bar's got 6 here, right? As you just had this nice rally, this is crude from yesterday. We went from basically 48.70 all the way up to 48.95. And if you're watching imbalances, you could have seen, yeah, here we're starting to see a lot of buying imbalances. Okay, that's bullish. So most traders that use order flow are familiar with imbalances. Okay, and they're most familiar with stacked buying imbalances, and that's what this green area is, where you have 3 or more imbalances stacked on each other. That's nice, but this buying imbalance is coming after you just had the 25-cent move. That's not very helpful to you, right? You just moved 25 cents and you got stacked buying imbalance. Well, what good is that? What you want to be alerted much earlier, right? And you can see here, these bars have these pink boxes around them. These are bars with multiple imbalances. Now they're green bars with multiple buying imbalances, as we call multiple buying imbalance bars. And imagine if you're just looking for stacked imbalances, well, it's coming up here after the move. Oftentimes you're going to see imbalances coming in bars that are not neatly stacked on top of each other. Maybe they're spread out, a tick or two at every price level. But if you're looking for bars with multiple imbalances, you can catch the move a lot earlier. Now, selling imbalances, it's the same thing, but in opposite. So you can see 18 against 4, right? That's a selling imbalance. That's more than 4 to 1. Obviously, 0 against 27, 5 against 27. Here in this other bar, 3 against 34 is like 10 to 1. 3 against 19 is what, about 6 to 1. 6 against 42 is 7 to 1. 14 against 86 is about 5 to 1. Those are selling imbalances. The black numbers are just your normal order flow going through, right? It's not an imbalance. It's just the market facilitating trade. So you can see here selling imbalances, right? Here's this bar's got 3, this bar's got 4, this bar's got 2, as the market starts selling off. Now here you got a nice stacked selling imbalance. You got 3 selling imbalances stacked neatly on top of each other. 1, 2, 3. Okay, that's great. And the market sold off. But if you are trained to look for bars that have more than 3 imbalances, but are not neatly stacked on top of each other, you could get into this move a little bit earlier. Here's a bar with 1, 2, 3, 4, right? How do we know? It's got that box around it. Simple, right? You don't have to make trading so complicated that you need bells and whistle. All you need to be alerted to, hey, you know what? We're going sideways, but aggressive sellers have come in here. We're seeing multiple selling imbalances coming in. Okay, market starts to break. Yeah, I get short here, 48.80, goes all the way down to 50. Right? You don't need to sit here, oh, well, now I got this selling imbalance. It's coming in, 5 cents lower, 10 cents lower that you're getting short at, right? It's going to give you a better entry because you're going to be alert to what's happening in the market as soon as it happens. Now, imbalance, stacked imbalance, multiple imbalance bars, they occur in just about every market and every time frame. So here's the E-mini 1-minute chart. This is in the middle of the night last night, okay? This is 1 a.m. Chicago time, European Open. Okay, you see a lot of buying imbalances. Yeah, that's nice to see. You have a nice stacked buying imbalance here. Yeah, that's great. The market went up. But you could have been alerted, 3 points, not 3 ticks, 3 points earlier down here with the multiple buying imbalances. You just got to know what to look for, right? Again, trading is not so complicated that, traders like to make things complicated for some reason. Just look for the simple things in the market. Now, that's not to say go out and buy every bar that's got 3 or more multiple buying imbalances, or sell every bar that's got 3 or more selling imbalances. But, you got to still put it in context. But it's going to give you, trade opportunities that other people just don't see. Here's E-minis yesterday, 9:45, right? We got this bar right here. Everyone's going to see this big down red candle. Oh, that's bearish. I got to get short. You're getting short down in here. So I don't know, 37.18. But right before that big bar down, the bar that went from 25 all the way down to 18 or 17, you had a bar here. You got this little bar with a lot of selling imbalances, 3 selling imbalances. So tell me, would you rather be short from up here at 24, 25, or short from down here at 17, 18? Well, of course, you should want to be short from, 7 or 8 points higher, right? And that's how looking at multiple imbalances in a bar can get you into trades much sooner, right? Everyone, like I said, everyone's going to see, oh, hey, we broke out this low here, got the big red candle. Yeah, it's a good short here. But you get, you know what? The market's looking weak right here. I could short this. My stop is just going to be right up here above 28. I'm getting short at 25, a nice 3-point stop, rather than getting short, at 17, 18 and having a stop, twice as big. Here's gold, right? Like I said, multiple imbalanced bars appear in all markets, right? Markets selling off, right? You're seeing, here's a red bar with multiple selling imbalances. They're not stacked. Here you got your stacked selling imbalance. Market went a bit lower. Then right off your swing low right here, we got 1, 2, 3, 4 buying imbalances. Market went sideways before it started popping back up. Again, a move from, 38 all the way up to 41, 41 and a half, right? And it came well before the stacked buying imbalance appeared in here. Here's crude oil, 1 minute chart. Knowing where the imbalances are going to keep you on the right side of the market. So, here you got some bars with multiple buying imbalances, no stacked imbalances, right? The only stacked selling imbalance or imbalance for that matter is right here, okay, in this bar. You don't see any stacked buying imbalances here, here, or here, but what you see is a bar with multiple imbalances, a bar with multiple buying imbalances, followed by a bar with multiple selling imbalances. So imagine, you're long, okay? You get, I got bar multiple imbalances, you get long, okay, that's good, I'm gonna stay long. And then you start seeing this bar is forming, you're starting to see already 3 selling imbalances. That's not a good sign, even though they're not stacked. But if you're watching the order flow, if you're getting long in here at 47.90, where do you put your stop? You put your stop, this might be a bit wide, but 47 70, 47.65, somewhere in here. The point of control here is like 70. This low, I think, was 65 or 64. Maybe you hide behind these 2 levels, but then you see this big bar down with multiple selling imbalances. Oh, you get out, right? You're long from 90, you're trading 80, but you got very bearish order flow. That's your sign to get out. Get out at 80 rather than getting out at 65 or 60. You can get out of the trade. You can cut your risk almost in half. So imbalances are one way to see aggressive traders in the market, but there are other ways to see aggressive trading, which may not be revealed by imbalances. So the other form I want to talk about is market sweeps. Now, people think that, market sweeps are something new in the market. No, they've been going on for ages, and most people don't think of it because they just don't have the experience, right? And actually, the old NYMEX COMEX electronic trading system, which is called Access, had a feature on there. This is back in the mid 90s, where it was called market sweep. Okay, and say the gold market was 1891 bid, and you're a big seller. You just want to sell everything right now. You got 100 contracts to sell the gold at 6 in the morning, and you can see I could sell 100. You look at the dome, right, the price ladder. You say, I could sell 100 all the way down to 1890. So you just put it in 1890. You sweep. You hit all the bids. Boom, you're filled, just like that. And a market sweep occurs when an aggressive buyer lifts the offer and the next best offer is behind it, or an aggressive seller hits the best bid and the next bid's below it. So how does that look, right? On time and sales, right? This is what happened, right? This pink area, the market was 86.5 bid. Someone came in, sold it all the way down to 86, right? Now that was just 2 price levels, but that's a sweep, right? They cleared out the 50s, cleared out the 25s, and they're working double O's. Now on a price ladder, right, you'll see, the market's 86.25 bid, below it's 86, below it's 85.75, below is 85.5. And you'll see, I got 500 to sell. Okay, well, I'm going to sweep it from 86.25 all the way down to 86.5, right? I'll take it down about a point. Okay, so what the trader would do is they would enter sell 500 down to, and with the price as 85.5, right? Even though we're trading 6.25, 6.5, the price that they're willing to sell it all the way down to is 85.5. People say, well, no, they don't do that. Bullshit, they do that. I've done it. All my colleagues do it, right? And the reason is we want to get into the market as soon as possible. We think the market's about to move and we don't want to miss anything. Okay. So yeah, okay, I could get about 500 sold all the way down to 5.5. And when I'm 5.5, I get the residual. I think people will come in and lift the offer, and there might be some orders iceberged in there. Again, if you're a big trader, you're not concerned with, oh, I got 52 or 89 here or 163. You're just concerned with your average price. Right? If I'm a big trader, I got a lot to sell. I book my trades at the average price, not the individual levels. But I know that my order, if I hit them when it hits the market, is going to move the market. It's going to shift perception of the market. That's why they'll come in and sweep. So even though I sweep from 6.25 down to 5.5, most of my average price is probably going to be around 85.75. The market's now 85.5 offer, 85.25 bid. Okay, and my average is 85.75. Happy days for me, because now the market, based on my expert trading analysis, is going to go lower. So my average price is 85.75. We're now trading 85.25, 85.5. Algos come in, hit the bid at 85.25. Next thing you know, it's offered at 85 even. That's how the markets work. Now, imbalances highlight areas of aggressive activity, and a market sweep is also a form of aggressive activity, but doesn't always mean it's an imbalance, right? Here, you can see there's market sweeping occurring. Right here, yes, you have imbalances because obviously you got 0, 1, 0. Anytime you got zeros in a bar, it's going to cause generally an imbalance. But you can see here's some sweeping activity early in this bar, right? You can see, 25 traded here, 22 against 8, 40 against 10. So, you were highlighted a bit earlier in this previous bar with the market sweep and with the imbalances. And then you're getting further confirmation that, yeah, this market should be selling off nicely, right? And it did, right? It sold off from the 80 area all the way down, to 70s. It's crude oil, 1 minute chart. Imagine if you knew where a big fat trader was sweeping through the order book. Well, now you can, right? This is one of my favorite pictures. Sweep the leg. Anytime someone would, say, hey, you sweep the book, you would say, I'll sweep the leg. But you can, right? If your software is going to highlight it. Why can't you have software that's going to highlight it to you? That's what I wanted when I was trading with Orderflows. Like, rather than me staring at the chart all day looking to decide, is this or isn't it? Let the software highlight it to you. Here, there's 2 market sweeps in the book, right? This is right here, right? This second sweep right here, where it's coming in around the 48.40 area, this is what happened immediately afterwards, right? We dropped yesterday. And remember, crude, we sold off about 100 points, 100 ticks almost, instantly. You don't see multiple imbalances in here. You don't see stacked imbalances here, right? Even in this bar, you see multiple imbalances. But this is the bar you want to be short on. Again, this is a 1 minute chart. Imagine you're getting short here, 48.30, somewhere in here, 48.25 even. And then 2 bars later, it's trading 47.50, 47.70. Those are the trades as traders you love. The ones that just, as soon as you get short, market moves in that direction and it moves there quickly, right? You don't want these, me, I'm impatient, right? I like my trades to start moving pretty quick, pretty soon. Okay. And that's where having the right tools can help you as a trader. Euro currency. Now, you can see here, right? Market's just going sideways. Someone started coming in, a big order came in and swept. Now, again, don't get all excited and think, oh, there's sweeping here, there's sweeping, I got to get long, I get short. Take it in context of the market and what's happening overall. Again, if you can be getting short in here, 92, 93, it made its nice move down to, 83, nice 10 ticks in the euro currency. Again, 1 minute chart yesterday. So market sweeps and stacked imbalances can and do overlap because they're both very aggressive market behavior. Where it gets juicy is when a sweep occurs and there's no stacked imbalance, because most traders are looking for stacked imbalances, but practically no one is looking for market sweeps, right? This is gold yesterday. Now gold is a thinner market than, say, E-minis or crude. So you're going to want to adjust the sweeping settings a little bit. But you can see here, right? Came down into this low, very aggressive buying going on in the form of market sweeps. right? This whole bar is basically someone just came in and started buying it off, 42.5 all the way up to 44.5. And then we went all the way up to 47.5. Some more bearish sweeping came in here, down from 46.5 down to 44. Some bullish sweeping came in all the way back up to 46. Bearish at 45.5, back down to 44. So again, there are settings you could adjust depending on the market. So hopefully you can see how following what the aggressive traders are doing is going to keep you on the right side of the market. Imagine again, if you're getting long up in here, right? Say, oh, you had this nice move up. I got to get long. All my indicators are turning bullish. I got to get long. I get long up here at 47. As soon as you get long, you see a market sweep come in. Do you think this market's going to keep going higher? It might, but the odds are that it's going to go lower. Then it starts selling off. You know what? You get out and then you get short. Oh, I just had a bearish sweep. I got to get short. You get short down, somewhere down in here at 44.5. But then you start seeing bullish activity. You see a bullish sweep come in. Okay, yeah, I better cut it now. Cut my losses small. You don't want to let this go all the way back up here. And, I got to get out here at 46.5, 46. Get out, $1 earlier, right? That's what talks about that's what I mean when I say stay on the right side of the market. Right? Let the order flow tell you the direction of the market, either through imbalances or market sweep. Right? Being in sync with the market is what you want to do as a trader. I hate to use the term in Caddyshack, be the ball, right? Be the market. Because remember, aggressive traders are the ones who move the market. For a market to go up, aggressive buyers need to outnumber the passive sellers. For a market to go down, aggressive sellers need to outnumber the passive buyers. Aggressive trading will show up in the order flow in several different pieces of data. The delta, imbalances, the bid volume, and the ask volume. But, who wants to really get that finite, get out the magnifying glass and start analyzing this volume against that volume? Let tools do it for you, and market sweeps. Trading in the direction of the market is just one way to approach the market. Order flow also allows you to see the market turning points, because when a market reverses a move, that's a tremendous opportunity for you. Why? Is because the perception of the market can have completely changed, right? Don't get so caught up into a bias that you can't change. Like I said, yesterday, someone I know had a bias to be long this market, be long the S&Ps, and they got hammered. They lost, got bought again and got lost because they had a bias rather than just following what the order flow was telling them. So another way to use order flow is to find potential market turning points based on the volume and, more importantly, where it appears in the bar. Now, in most bars, volume is generally distributed in a bell-shaped curve, meaning most of the volume trades around the center, midpoint of the bar, more or less. Not always, but most bars do that. Okay, but in order flow, you can see where the most volume occurred. Okay, the price level where the most volume trades is called the point of control, the POC. Now, every bar has a point of control, and most of the time, it's somewhere near the middle of the bar. So last night, this is a daily bar chart of S&Ps yesterday. Why did we come all the way up to that level and stop and turn? Well, this is where it was on a 1-minute chart on a footprint chart. Okay, yeah, you can see, well, yeah, I got some selling imbalances, but again, what else do you see? Well, you see most of the volume, majority of the volume, let's say majority, but the level where most of the volume occurred is right up here near the top, right? Then the market came down, went back up. Where do we trade? We traded right back up to that level, right? We got a nice triple top here, 1, 2, 3. And again, where's the most volume? These two bars have it right here at 73. Again, we came up here, we traded 73.25. You got some decent volume up here before the market started going sideways and then selling off. So there's going to be times where the point of control, right, the price level with the most volume, appears at or near the edge of a bar. And that means something. Usually it's resting liquidity, which is a big order, right? We all, some traders are familiar with a book map or a heat map, which shows resting liquidity in the market. And, they sort of build their whole trading plan around resting liquidity. Point of control will also show you that resting liquidity, right? It's the stopping volume, right? It's a big order in the market. And in order flow, I call that the prominent point of control, which is basically a point of control that acts as support or resistance. Now, remember, every bar has a point of control, but not every point of control means something, right? That's why Orderflows Trader highlights the point of controls that matter, right? The prominent points of control. And you can see here, right? Here was a bearish prominent point of control. You had a bullish one here, right? And you'll notice the market sold off from here, it came down here, went back up to the bearish prominent point of control, came down. It was holding for a little while. Eventually it broke. This is going to be your prominent points of control are going to be market generated information, which gives you real-time support and resistance levels, that's formed by the market. It's telling you, as we were going up, there was a big bidder here, right? As we came up to the high of the day, there's some selling activity there. Doesn't have to necessarily be passive. It could be passive and aggressive. Okay, this is the E-minute mini on a 5-minute chart. This is your prominent point of control that happened right up here at one tick off the high. And again, you can see, where did we come off? We came off, we rallied back up. We got within one tick of that prominent point of control right here, right? This is your resistance level. This is 10 years, the ZN. And the thing about order flow is sometimes there's some markets that seem to follow order flow a heck of a lot better than other markets. And I always say, sort of these markets that are not cash settled, meaning they're deliverable, tend to follow support and resistance a bit better than cash settled markets, because the way the market is designed, people got to actually take physical delivery of it, and bonds and tens are physically deliverable. So they tend to follow support and resistance, in my opinion, a bit better than some of these cash settled markets like E-minis, NASDAQ, micros, etc. Look at this, 10 years, right? 10 years is one of the most liquid markets in the world in terms of volume on the bid, volume on the offer. And you can see here, right off the low of the day yesterday, you got a nice prominent point of control. That's your support level. Look at that move straight up, right off of that. All right, that was just, the market just stopped right there. Now, the problem with the 10 years is it's not very volatile. People get bored to death watching this because there's just so much size. Sometimes it takes a lot to get through. I mean, look at this bid. There was 19,000 I had to get through here. Here's 18,000. Here's 20,000, 12,000. That's what it's like when you're trading 10 years. Now, bonds is a little bit moves, less volume and has a bit more price movement. Same with ultra bonds. But you can see here yesterday, just from 6 in the morning until 9 in the morning, you had a bearish prominent point of control to a bullish, up to a bearish, a nice sell-off down to a bullish prominent point of control, and a move back up. You can see how they're holding back up. Crude oil yesterday, this was just after 8:30 in the morning, big buyer right here, 48.20, right? Big move up. There's crude oil a little bit later in the day, 47.40. We eventually sold off. If you remember, we had that big drop in crude. But then, boom, market's going up, comes right back, gets this little swing high, pulls in a little bit, does this little rotation, and stops right here where you got some heavy volume, some stopping volume to stop the move down. There's buyers here. So it's telling you that's bullish, right? And the market started going back up again, right? That's how letting the software analyze the order flow for you to tell you, yeah, this is bullish, or yeah, this is bearish, or yeah, we have support or resistance based on what's trading in the market right now, right? You don't need the market to come all the way back up from 47.40 all the way back up to 47.70. Say, oh yeah, there's support here. As soon as it comes here, as soon as this bar closes, you're looking at that, from 10:40 onwards. If it's 10:39, you see that, yeah, okay, I got some support. I could buy it somewhere in here. I could have just a stop just right below this support area, because I know that that's my line in the sand. If we get past this, the whole reason for being in the trade is over. I could get out rather than waiting. Most people wait for you to break out of this high up here at 47.58 to get long, to confirm that, yeah, there is support here. Well, why wait? Get long here at 47 47 rather than 47.57, you know, full 10 points earlier. Yeah, you're just going to risk 8 ticks, 7 ticks. You know, it's going to help you get into trades earlier. So another way to see when a market could potentially be putting in a bottom or a top, which is going to result in a reversal, is by spotting delta shifts. Okay. So remember, delta is one of the 3 foundation blocks, right? There's delta, there's imbalances, and there's point of control, right? I've talked about imbalances. I've talked about point of control. Now I'm going to talk about delta, right? And delta is the difference between aggressive buyers and aggressive sellers. So if you have positive delta, it's telling you aggressive buyers are in control, right? If you have negative delta, it's telling you aggressive sellers are in control. And as markets rise, a bar is going to generally have positive delta. As markets fall, generally it's going to have negative delta. Not always. There's cases where it's the opposite, and that's a whole nother webinar. I've done presentations on that. But this was crude oil yesterday. Okay, crude moved nicely yesterday. A lot of markets had nice moves yesterday. But imagine this market's going up. You sort of get in here, you know, you're thinking, yeah, if you're long, you're thinking, yeah, this is great. We're going to go back up, hit 48.50. Or, you know, instead what happened is the market sold off from 48 bucks back down to 47.30. Okay. So, you know, imagine you're getting long here at 47.70 and going up, you're looking for a move up to 48.50. Then the market starts dropping, right? You got your stop down here. You're long at 70. Maybe you got to stop, you know, below here at 47.50. Okay. 20 ticks. Well, why let it stop you out? If you could read what was happening in the order flow, how it turned bearish in here, you could get out earlier. Again, you could be getting out at 47.80 with a small profit. You're long from 70. You're getting out at 80. Why? Because, yeah, you're in the money, but the order flow now is turned bearish. Why let it come all the way down to your stop price and stop you out for a full loss? That's what I have scratching my head. You know, people sometimes think that, oh, you know, I'm either going to be right or wrong. Well, you could still be right and wrong at the same time. You know, you're right that the market went up. You could book a small profit. Then you're wrong that it broke down. Why? Is because while there was bullish order flow on the way up, it changed in here, right? It became bearish. And by watching the delta, especially when you're in a position, helps you understand the direction of the market, right? If you're long and the market is kind of stalling, right? The delta is negative. That's a sign that the market could be getting heavy and is ready for a drop, right? Not only are aggressive sellers in control, but also, more importantly, for the market to go up, you need aggressive buying. And if the market is not showing you aggressive buying, it's probably not going to go higher. And this was that little area I was just showing you on the crude, right? You came all the way up from 47.70, you're trading 48 bucks. But what do you see? Right? Yeah, so I still got green bars, it's still bullish, but bullshit. You see negative delta, minus 300, minus 50, minus 2 is nothing, small, could be either way. So what I call a neutral delta, minus 184, minus 159, minus 262. Okay, well, it just happened. You just went up from 70 up to 48 even, but now selling is coming in, right? Selling continued here as we went down, but you're seeing it coming in at sort of a swing high, and it's mostly negative selling. That's what distribution is, right? The market rallied. Okay, now people are going to be distributing. They're going to be getting out of their position. They've got more inventory to sell. They're happy to sell it on this little rise up. That's your sign. That's where order flow is going to make things a lot easier for you as a trader. This is 10 years yen on a 5-minute chart. A little confused there. Now you see the market's coming down, right? Hard. Negative delta minus 12,000. Negative delta minus 4,000. Yeah, you had some buying coming in here, plus 4,000, which sort of wipes this out. And then a little bit of selling, right? Minus 300. Strong buying, plus 7,000. A little bit of negative selling, 400. A little bit of positive. Then strong buying, 4,000, right? So you just had this big, strong move down, very strong selling, you know, capped off by this minus 12,000, very little follow through. Now you're seeing strong buying coming in. Here you got multiple imbalances, 1, 2, 3 imbalances, okay? Very strong positive delta. These two are kind of mixed, up and down, plus 500, minus 400, but then plus 4,000, plus 3,000. Okay, you're not seeing the minus 4,000 negative delta. You're not seeing the minus 12,000 negative delta. Instead, it's gained all that back and it's turning positive. right? This is what happened. This is that area right in there on the 5-minute chart, on that footprint chart in the 10 years, right? If you're just looking at a bar chart, you're not going to see that information. Then you had this nice move up from 30 all the way up to 04. People say, oh, that's not much of a move from 30 to 04. Thing you don't understand, right? I mean, for a lot of traders is, a lot of retail traders just trade 1 lot, 2 lots, 3 lots, 5 maybe. Thing about 10 years is, since the market is so thick, there's a lot of people that like to move size, right? So I know some people, they trade 10 years, they just trade 100 lots, 200 lots. They're just looking for a few ticks, 2-3 ticks, and they're done, right? Because they've traded 200 contracts. They only need to make 2 or 3 ticks. They're not in and out scalping all day long on the E-minis or micros. That's how order flow is going to help you, right? Depending on your type of trading, whether you're looking at scalping 2 ticks or whether you're looking at trading 500 contracts, 300 contracts. So if you're short, right, I just showed you some bullish ones if you're long, or how to get long. But if you're short and the market's no longer moving lower and just kind of hanging around, you watch the delta. If you start seeing positive delta, remember, you're short, right? You'd be wanting to see negative delta. But if you see positive delta bars coming in, that's a sign that the market could be getting tired and is ready for a rally, right? Aggressive sellers could be running out of their bullets, right? They got no more to sell, right? I was just showing you that in the bonds. A lot of sellers, minus 12,000 delta. Then the next bar, minus 300 delta. Yeah, you had one last final push, minus 4,000, then that was it. All of a sudden, you had aggressive buying coming in, positive deltas. And again, that's going to give you a low risk trade, because if you buy at right off the low, I'm not trying to predict the low. I'm letting order flow tell me, you know what, there's no more selling in here, right? Just as in here, right, we came down here, minus 12,000, oh, that's bearish. Minus 4,000, that's bearish. Minus 300, plus 7,000. It's telling me it's shifted the perception of this market. The selling is gone, right? Instead, now I see some strong, positive, bullish news in the order flow, right? You don't want to see minus 12,000, minus 400, more minus 4,000, minus 300, and expect this market to go down. Then boom, you see plus 7,000 in the delta. You get long here at 28. Okay, where's your stop? Down here, 26, 26 and a half. And then boom, the market went up, because you don't see, all those sellers, they're done selling, right? They got no more inventory to sell. They got no more reason. They don't want to sell anymore. So that's how looking at delta is going to help you in trades. This is E-minis, right? Imagine you're short, big sell-off, boom, boom, boom. We're coming down 36.70. We cleared out 36.60. We cleared out down in the 38.50s, 36.50s now. And what do you see? Do you see any strong negative deltas? Yeah, well, here's minus 200, okay, but plus 200, plus 300, 64, 35, minus 161, still not really going anywhere. We're not going lower. Someone's coming in now and absorbing the selling. They're buying the bid, the working bids, but they're also buying the offers, right? When these sellers are offering it out, they're also buying it. And then boom, nice strong positive delta 300. Nice strong positive delta 400. Market starts rallying back up another 10 ticks. And again, imbalances 1, 2, 3, 4. Got that pink box around it. Again, visual trading is becoming visual nowadays, right? This is what it looked like, right? Market's coming off, boom, rally back up, boom, new low, not new lows, but coming down into these lows, taking them out, going sideways. Well, what's the market going to do? Is it going to be pausing, or is it going to rally? Well, based on the order flow in here, it's bullish. Why wouldn't you be buying it in here? Why wouldn't you be buying it in this bar, right? At 61, 60, 61, 62. A quick 10-point move in 15 minutes. So what I've showed you can be done just by looking at any footprint chart, but you need to know what to look for, right? I was just talking about delta shifts, right? But when the market's moving, especially like yesterday, where it's down hard, it's easy to overlook and miss, because you're looking at so many different things. A lot of people put all sorts of indicators on their chart for whatever reason. Oftentimes they're not even paying attention to them anymore. But in hindsight, it's easy to look back and say, oh yeah, this, you could have got short here, but you could have got long there. But if you have software that's doing the heavy lifting for you, shows you things like market weakness or market sweeps, it's going to put you ahead of everybody else. trying to figure it out manually. And again, especially like yesterday, if you're trying to watch the time and sales, forget it. It's moving super duper fast. Yeah, the average trade in the E-minis is like 2 contracts. Okay. And imagine how many contracts trade in a minute, right? So if you're trading 1, 2 lots, yeah, it's going to be a lot on the time and sales, and you can't process that information. It's too difficult, right? But what you want to do is you want to take those pieces and put them in your head. Now, the Orderflows trader chart is going to show you market weakness, right? It's one thing to have a footprint chart. Okay, maybe you could read the deltas and try to make something out of it and hope you're right. Have software that's going to highlight to you, yes, pull you a blue arrow telling you, yes, it's bullish here. You should be consider buying, right? And market weakness is like looking at the gauge in your car of how much gas you got left, right? Is it on empty or is it on full? Think of it in terms of market movement. Is there still gas left in this move? Can it go higher, or are we on empty? Now, there are 2 types of market weakness in terms of delta. There's bearish market weakness, which occurs when the market has been moving higher but can't sustain the move higher. The buying is weakening. Now, bullish market weakness, yeah, I understand. It's an oxymoron. You want bullish market weakness. Well, how could you have bullish weakness? But what that means is the market has been going lower, but the selling just tapers off and is exhausted. Basically, the selling is what's happening, is getting weak, not the buying. It's the selling that's been getting weak. So bullish market weakness, right? Market's been going down, but the sellers are getting less and less until the buyers take control of the market. The selling is weakening. So how can you tell? You watch the delta, see what's happening in the delta. So here you go, right? You can see the delta's positive, negative, 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 then turns positive and market rallies back up. Here's your sign. The Orderflows trader will put a little arrow there, tell you, hey, you know what? You got a bullish sign that the selling is kind of weak down here. Get ready for a move up. Here's another one. This is gold. Again, you can watch the delta, try to figure it out. Is it really getting weak or what? And try and guess. But let software analyze it for you. So bearish market weakness is the opposite. The market's been going up, but the buying is weakening until there's no more strong buyers, right? For market to go higher, you need more strong buyers. You got to watch the delta. You got to be asking, is the aggressive buying getting stronger or weaker as the market is going up? Or in this case, as the market is going down. Right, well, not really going down. This was crude oil yesterday, right? The market was just sort of hanging around in here, and then boom, you got some signs of weakness coming in here around the 48.35 area. And what happened next? We had that big drop from 48, came in here again around the 48.30 area, all the way down to the 47.30 area. Now, there's 2 ways to do this, right? The easy way and the hard way. Me personally, I prefer the path of least resistance. I want to let the computer show me what's happening in the market, right? There's no point in spending $1,000, $2,000, $3,000 for a fancy computer or some software when you still got to do all the analysis yourself, right? And try to figure out, is this bullish or is this bearish? Let the computer do it for you. That's why you invest money in trading software and a trading computer. So hopefully in this past hour, you'll agree that this has been time well spent, right? Hopefully you're going to come away and you could start applying some of what I just taught you on your own trading, right? If you already have a footprint chart, you could apply some of that. If you're trading on a bar chart, then I got something special for you. Now, I can't cover everything in a 60-minute training session. It's just impossible. There's so much information. I'm just giving you a taste, right? A taste of what you could be doing in your trading that could make you a better trader. So I got a special offer for you on Orderflow, and I'll give you a very special deal. It's the Orderflows Trader 3.0, right? Which is the charts that you saw in this presentation. Now, it runs on NinjaTrader. Okay, it doesn't run on Thinkorswim. It doesn't run on ShareChart. It doesn't run on TradeStation. I use NinjaTrader because I'm a futures trader. Okay, that's my wheelhouse, so to speak. It's been that way since I started in the industry 25 years ago. And NinjaTrader is stable. Some people say, "Oh, it's not stable," but they're using a computer from 5 years ago. Nowadays computers are so cheap. You can get very good computers for $500, even monitors you can pick up for $100, $200, not even. You can get a nice 32-inch monitor. It's a volume footprint chart, the Orderflows Trader 3.0, but it has 17 pre-programmed order flow tools. I've talked about a couple. I've talked about multiple imbalances. I've talked about market sweeps. I've talked about market weakness, but there's a lot of other tools in the Orderflows Trader 3.0 that's going to help your trading. Show you price exhaustion, for example, show you value area setups. And the beautiful part of the Orderflows Trader 3.0 is it's very easy to set up. It's not one of these things where you got to be spending an hour going through the setup. The default setups are for an E-mini 1-minute chart, which is what most people look at, honestly. You don't need templates, but if you do need a template, just message me. I have even quick videos show you how easy it is to set up a template. Really, to set up Orderflows Trader 3.0 on NinjaTrader takes 2 minutes. Normally, I sell this for $8.99. And the Orderflows Trader, what it does is it takes my knowledge of trading order flow, puts it into a program so you can see what institutional traders are doing in the market. It's like having me sitting on a chair next to you saying, hey, you know what, tapping you on the shoulder, market is weak up here, or there's resistance being formed. But I realize having order flow software is one thing. You need to know how to use it, right? A lot of people you spend $1,000 on software, and then you get it and you got like 5 pages of instructions. I don't just give you software and hey, go on your way, let you figure it out. No, I'm going to give you a lot of education to show you not just how to use the software, but how to trade with order flow. Now I have a course, right? It's called Trading Order Flow. There's 20 lessons in there. Normally I sell this for $297. You're going to get it today for free. You're also going to get access to all the videos I created for the Orderflows Inner Circle. There's 56 videos. They're about 35 minutes to an hour long of advanced order flow tricks, tips, and analysis. Okay. You can get all that for free so you can understand a lot of the nuances and special situations that you should be looking for in the order flow. And you start adding this up. The software is $8.99. The training is $297. The Inner Circle video series is $1,600. Right? That's a lot of money. But again, you shouldn't have to pay that much, right? And you're not going to pay that much. Now, the problem with trading, trying to learn from watching videos. A lot of people like to watch videos on YouTube, and figure, oh, I'll just learn from there. Trying to figure it out on your own it's hard, right? Because you got to apply yourself. And what I've found very helpful is having live training where you can come in, ask questions. Now, this is not a live trade room, right? Where I'm sitting here, buy here, sell there. No, you're not going to learn that way. I'm going to give you each week, Tuesday nights. Today's a Tuesday. There'll be a session tonight at 7 p.m. Central Time. It's a live user training session, only open for users of my software, where I drive home what I saw in the order flow for the past week. You can ask your questions about areas you may be struggling with. I show people how to, adjust their settings, etc., depending on their markets. Now, I've been doing this for over 2 years. There's over 100 there's over 100 episodes. There's 102. I've been off for the last 2 weeks because of the holidays, and you could have access to all the replays. Now, I'm not going to expect everyone to go watch 102 episodes, but if you got time to kill and you're really interested in learning more about order flow, it's a great way to learn more about order flow. And again, if you can't attend, you will get access to the replay. So other gurus out there that sell software for a lot more charge you to teach you how to use their software. For what? You just dropped a lot of money, and then they want to charge you extra to teach you how to use it. What the heck is that about, right? I've seen other companies selling software for over $1,000. They want to charge you $200 a month to come into their trade room or whatever and show you how to use it. No, that's ridiculous, but people still do it. So when you start adding all that up, the software, the training, the Inner Circle video series, the weekly live trainings, that's close to $2,000, but you're just going to pay a one-time payment, $749, right? You go to orderflows.com/oft3.html. Make sure you put the .html. That's it, $749. There's no recurring payments. I'm not one of these guys that's going to be charging your credit card bill forever, and to cancel the payment, you got to go, stand upside down, jump through hoops or anything like that. There's a lot of people, that they I trade, right? It's what I do for a living. People they want to sell you software as their living, right? That's why they charge you monthly, because they want to keep having money coming in, right? Because they're not actually, that's their business is, I'm going to just get more people in, pay me, $100 a month, $200 a month, and never offer a chance for someone to say, you know what, I love your software, I want it, just buy it, right? Instead, they want to keep billing people forever ad infinitum. But there's no other payments you got to make, all right? Upgrades, the Orderflows trader, we've done two major upgrades in the last 5 years. We do them about every 2 years. We just did one recently, back in October. The upgrade's free, right? Even if um, you come back to me, you buy it now and then you don't use it for a year, you come back to me and we do an upgrade. Yeah, you're still going to get the upgrade for free. Now, the only thing you're going to need to pay, but it's not payments to me. Obviously, you got to pay data fees. You got to pay NinjaTrader fees. If you're on the paid version of NinjaTrader, you got to buy that. But the software will work on the free version of NinjaTrader. But again, what other people are saying is, the order flows traders helps them see what's really happening in the market, like who's in control at a very specific time and who's getting weaker, right? Another guy, Ziad, says, if you really want to trade properly and understand what on earth is happening in any markets, order flow is the path forward. In Mike's experience and explanation, it clicks, right? Again, I don't come here saying, oh, I've traded my own account for 5 years. Now I have the software, you should buy it. This is what I did. I traded on a professional level for over 20 years, right? That's how I lived. That's how I survived. That's how I paid my house. That's how I paid my car. Put food on the table is by working in a trading firm, right? Not working as an accountant or working as, an engineer. No offense to those lines of profession, but I traded for a living. I didn't have some other side business or some other main business, and trading was a side business. That's all I did. I hate to use that term, eat, sleep, trade, but as soon as I walked out of the office, I didn't want to have anything to do with it. But from 6 in the morning until 6 at night, I was in the markets. I was involved in the markets, trading constantly. So go to orderflows.com/oft3, OFT3, the number 3.html. It takes you to this page, right? You just scroll down to the bottom of the page. There's videos you could watch and more examples, but you click on this button to get started. Click here to buy now. You can see $749. That's it. Lifetime access to Orderflows Trader, the training course, the Inner Circle video series, the weekly live group trainings, and it takes you to PayPal when you click on that little red, what's that, orange, yellow button. All right, it takes you to PayPal. I don't get your credit card information. I don't want your credit card information. It's handled through PayPal. You can pay in Bitcoin if you want, but you got to email me. And after you make payment, once your payment is processed, I'm going to email you everything, right? The software, show you how to download it, your license information in there, your username and password for all the courses. So again, it's just a one-time payment, $749. So you got a few choices, right? Option one, you could do nothing, stay right where you are right now, going in circles, okay? And for some people, that's what happens. They don't do anything, and they watch videos, they watch my presentations, and then they don't do anything for a year, 2 years. They just keep watching videos, trying to think they're going to learn it on their own. Jump to the front of the line. Let me help you. Another option is you could take what you learned today, go out there and see if you can do it on your own. Trial and error for the next few months. Perhaps if you're lucky, maybe you could see some positive results. Don't put the horse before the cart. Put it after the cart. Let me help you. Option number 3, let me take you by the hand and allow us to walk you step by step through each part of the process. Skip the trial and error. Right? Trial and error costs money. People think, well, I'm trying to figure it out on my own. Meanwhile, they're losing money. More importantly, you're losing time. You're losing your life trying to figure it all out. If you do the work, you'll watch as your life and trading transforms right before your eye. So you have to figure out which option is best for you. Try and figure it out on your own, or do nothing, or let me help you, right? But you got to figure out what motivates you, right? What freedom do you want? What freedom, have freedom to go where you want, freedom to do nothing. For some people, doing nothing is freedom. This summer I went to, took the family, we went to South Dakota, right? We went to Mount Rushmore and a few other places. that's what trading does. It gives you freedom, right? It lets you say, you know what, I don't want to work this week. Hey, let's pack up the car, take a drive someplace. Okay, that's what you can do when you're a trader. Now, as a special bonus for Investors Expo, since they put this together, I'll also give you access to one of my favorite courses, the Orderflow Playbook, right? Normally I sell this for $297. You're also going to get that for free, right? But you got to get started now. Right, you got to go to orderflows.com/oft3.html. So what you're going to get is the Orderflows Trader 3.0, the Orderflows Trading Course, the Orderflows Inner Circle video series, access to live weekly group training, and the Orderflows Playbook, right? That's well over $2,000, but you're going to get it all for just a one-time payment of $749. Again, no monthly recurring payments or any other payments in the future. Now, if you stuck around and you're interested in my book, go to orderflows.com/book.html. I put the link in the chat so that you can easily find it. You just got to enter your name and email address, then hit submit, and then it'll take you to the download page. When you enter orderflows.com/book.html, it's not going to be there. You have to enter your name and email address so I know who you are, that you're a real person, so you get access to the book. So get started now. I mean, don't waste any more time. We've just really almost a year into this pandemic, and there's traders that have done well trading in this pandemic time. People have been losing their jobs and wondering what they're going to do to support themselves, or just maybe looking for a little bit extra income. If you figure out a way to make order flow work in your trading plan, or more importantly, build your trading plan around order flow, then you're going to be ahead of all the other traders struggling to make it out there. So again, I'm not going to make promises that, oh, you're going to make $1 million next week. It takes work. You have to put in time. You have to put in effort. It's not going to all just magically fall into your lap. I'll give you an example. There was a time in my career where I had to make a decision. Basically, my boss was giving me the opportunity to start trading, and I was a little bit gun shy, honestly. I was like, oh my gosh, there's a lot of money involved. But I knew this is what I wanted to do. And he just said, hey, Valtos, if you don't do it, I'm going to get so-and-so to do it. So damn sure I started banging away on the computer, figuring it out, because, as a person, I don't like to make mistakes, and mistakes cost money when you're trading. It's not like, working in a grocery store. Nothing wrong with working in a grocery store. I did that when I was in college. In a grocery store, you make a mistake. Yeah, you put the cornflakes where the Wheaties go. In trading, you make a mistake, it costs money, right? And then nobody likes to lose money, because when you lose money, you feel like you're, I say, lesser of a person, but you don't feel good, even if it's not your money. You'll still take it and feel the emotions of it, but unless you get started, and unless you get up off your butt and start doing things, you're never going to see results, period. There's just no way around it. So, just a couple of quick questions that come up. Will the software work on TradeStation or Sierra Charts? No. My software, the Orderflows Trader, works on NinjaTrader. Will it work on stocks? Yes, it will work on stocks. Will it work on Forex? No. Problem with Forex is the data is not centralized the way it is generally from the stock market, and how it is from the CME group. Because it's one exchange, they trade everything. The problem with Forex is all the big banks, they have white labels. Okay, what white label is, they give their Forex front end to a company, and then that company offers it out, as a broker's business. So, you could be trading a front end that's being provided by Deutsche Bank, and somebody else could be trading a front end that's provided by Barclays, and you're getting data from a completely different source. So the data is not centralized in that sense, and it's not giving you accurate representation of the market. I mean, in generally, it's mostly right, but it's not really. People say, "What about Bitcoin?" Last year I really started jumping big into Bitcoin, but who really trades Bitcoin? It's where you just buy it, you just hodl it, right? You don't really buy and sell. Maybe on a short term, you move from one crypto to another, but yeah, on the CME Bitcoin, Yeah, you can. You can use it. NinjaTrader does provide access to, allows you to connect your NinjaTrader up to Coinbase and I think one or two other exchanges. But yeah, honestly, the data that comes from there is not really good for order flow because it doesn't really show you the true bid and the offer. And the one nice thing about some of these exchanges is at least you're getting the data from them and you can trade that exchange. Whereas with Forex, you may be getting your data from data company A, but you're trading, through a front end through a bank which has slightly different data. So anyway, if there's any other questions, I don't want to keep you guys on too long. I've gone about an hour and a half. Just send me a message. It's Mike at Orderflows is my email. But again, get started. Go to orderflows.com/oft3. And again, the links are in the chat so that you may download the book or go directly to that page, orderflows.com/oft3. So thanks, everybody. Thanks for taking this time out and have a great rest of the day and rest of the week. Bye-bye.